The McIlvaney Weekly Commentary, covering monetary, economic, and geopolitical news events. Now here are Kevin Orrick and David McIlvaney.
Welcome to the McIlvaney Weekly Commentary. I'm Kevin Orrick along with David McIlvaney. David will be joined today. We've talked about this for weeks with Dr. Marc Faber here in a moment. But unemployment, that seems to be on everyone's mind right now. Are we getting accurate figures? Is it going up? Is it going down?
Well, the June numbers, Kevin, of course, were 9.5%. And if you look at U6, the broader measure of unemployment, that's over 16, nearly 16.5%. If you use some old metrics and factor in everyone who actually is off the payroll, discouraged workers, people who have not looked for over a year, you actually end up with numbers as high as 18.2 to 20.5%.
So these are people who maybe would like to have a job but have either become discouraged or just cannot find a job in more than a year.
Right. Now, there's not a lot of clarity in terms of what the unemployment numbers mean because the Bureau of Labor Statistics factors in a number of things that are pure fiction. This last month, in June, 467,000 jobs were lost, but the BLS helped you get to that number by fabricating 185,000 jobs.
Just out of thin air.
Right. Yeah. So the good news is the Bureau of Labor Statistics, using their birth-death modeling, tones down that fabrication in the second half of the year. Their model is more active, if you will, in the first 6 months of the year. Telegraph reporter Ambrose Evans-Pritchard reminded us in a recent missive that the reason why this does not feel like the 1930s in terms of recession and depression even, is that we tend to compress the chronology of the depression. He says,
we tend to put it all in one moment versus looking at how long it takes to get from place to place.
Right. And he says it takes time for people to deplete their savings and sink into destitution. So one of the questions we want to ask is, as we discuss with Marc Faber several different issues today, could exploding unemployment and exploding debt levels at the national level here in the U.S. sink us into a new round of deflation? Countering that, perhaps, we've got monetization. This week, the update, this week $7 billion was monetized. Those are the 2014 to 2016 vintage treasuries. Monetization of shorter-dated treasuries, note, and a real question to keep in the back of your mind, Kevin, is what happens to long-dated treasuries if we're having to monetize the short end of the curve? Certainly there's going to be a lot of monetization we would expect in the long end of the curve, too.
Which the unemployment is the deflationary argument. Monetization leads to inflation. The printing of money, monetization, leads to the dilution of the currency.
The last two things I want to mention before we dive in with Dr. Faber, one, a note on Goldman, another, a note on the Federal Reserve.
Oh, the company that runs the world, Goldman Sachs.
Well, and there is a strange relationship even between the Fed and Goldman. Goldman's in a bit of a crisis moment this last week. They had some software stolen, which was sent to a German computer server, and the assistant U.S. attorney in federal court told a federal judge that this software in the wrong hands could pose a threat to the U.S. markets. I quote, he said, "The bank has raised the possibility that there's a danger that somebody who knew how to use this program could use it to manipulate markets in an unfair way." And I just think, Kevin, what was he thinking? So Goldman gets to play games with Joe Q. Public and manipulate market trends, but in the quote-unquote wrong hands, Joe Q. Public could be at risk?
I wonder if we should call that the Goldman egg. They've lost the Goldman egg now. It's in the hands of who?
Exactly. Yeah. It just reminds me, Kevin, that there's two kinds of people in this unbelievably corrupt environment: the politically protected and the politically vulnerable. And I read a speech, speaking of politically protected and those who are insiders. William Dudley, who's the current president and CEO of the New York Fed, recently spoke at a Bank of International Settlements conference. This is the central bankers' bank, if you will. The conference was in Basel, Switzerland, about a week and a half ago. Kevin, I'd like to remain respectful, but frankly, it's very difficult when you read his thoughts on the, quote, lessons we've learned from the financial crisis. Things like this: monetary policy cannot prevent bubbles. In fact, his view is that adjusting short-term interest rates is viewed by the Fed as an ineffective tool in countering the development of bubbles.
Oh, so rather than being a causer of bubbles, like Alan Abelson said last week, when he was saying Greenspan can be identified as the creator of the last couple of bubbles. What he's saying is it's ineffective.
He's arguing basically for a larger toolbox and greater control for central banks across the globe. It's interesting because Dudley proclaims the Fed's innocence in the fostering of the real estate bubble here in the U.S. by pointing to lax underwriting standards, which resulted, in his opinion, from home prices growing at a faster pace than income. Now, seriously, this guy is helping run the ship. I mean, not just running it, but running it into the ground.
And he's saying that it's not the Fed's fault. Please give the Fed more control.
It's an interesting thing, Kevin, to see the quote-unquote best and brightest, and Abelson this last week said they may be the best paid, but I'm not sure they're the brightest.
Well, you know, it's interesting, Dave. Our guest that's coming on today, I mean, there was a great quote last year when we had him on the show where, what did he say? The Federal Reserve, these guys are criminals? They're worse than the mafia?
Mark, I think you said they're worse than the mafia. Well, hey, let's dive in, Dr. Faber. The case for deflation or inflation. This is one of the defining questions for investors today. You might look at the destruction of $14 trillion of credit and only $2 trillion of market liquidity being used to fill that gap as a way of saying, yes, they're printing money, but not enough to make a difference, and we're slipping further into deflation. On the other hand, we've heard strong arguments for either super or hyperinflation. Where should we go from here?
Well, basically, there is this debate whether the U.S. will experience in the next 5 to 10 years high inflation rates or whether we'll go into deflation. And I'd just like to say that both parties may be right. We may first have deflation and then inflation. And so somebody will go and say, well, see, I told you so. And then 2-3 years later, he'll be wrong. It's like if someone said in 1998 the NASDAQ is a bubble, so for 2 years he was wrong, but afterwards he was said right on the mark. And sometimes it's very difficult to predict these things. I'd also like to mention that, yes, even under a gold standard, since you talked about bubbles before, you can have bubbles. And if you look at the last 200 years of economic history, we had many bubbles. In the 19th century, when we didn't have any inflation at all, such as the canal boom, the railroad boom, then different real estate booms as the country was moving west. But the point is, usually, when you have a bubble, it's a bubble in one sector, and at the same time, some other sectors deflate. Say, the Japanese stock market bubble in '89 was accompanied by deflation in commodity prices, which had peaked out in 1980. What Mr. Greenspan and Mr. Bernanke, his assistants at the time, created is a bubble in everything, with the exception of the dollar. For 2002 to 2007, stocks worldwide went up, real estate worldwide went up, commodities went up, art